Hi, I'm Eric Ludwig. I'm a certified financial planner and the CEO of Stockbridge Private Wealth Management. Today is November 28th, 2018, and this is the November market recap. I know it's not the end of November, but tomorrow we're actually leaving on a trip to visit my parents in Florida just for a week. So I wanted to make sure that I got something out to you. So sorry it's a little bit early. So in this month of November, what we've seen is uh, basically both stocks and bonds are basically flat for the month, but it's been super volatile again. We've seen them all over the place. Right after the elections, election day, um, stocks jumped, and then we had like 5 days in a row that the market took a big dip. The important point that I wanted to make is that it seems like stocks and bonds have made a bottom, and now we're starting to come off those bottoms. So a downtrend would mean that they're continuing to make lower lows. That hasn't been the case. It's that bleeding has stopped. One thing that we noticed in November that kind of created a lot of this volatility is what was going on with interest rates. So we saw the 10-year Treasury bond go from 2.8% up to 3.4 and then back to 3 again. So that creates a lot of volatility in both stock and bond markets. Today, the Federal Reserve Chairman Jay Powell said that he thinks that rates are just below neutral. So that's good because that means that they're probably not going to continue doing a lot of rate hikes. It seems like that's starting to throttle back. And he also said that there's no preset policy for their rate hikes and they're going to continue to monitor the data. So for whatever reason, the markets really like that today. They had a big jump. That's kind of what's been going on in November itself, but we wanted to also take a look at some other bigger picture items of things that we're watching, and one of those is valuations. So I'll warn you, this is sort of the bad news of this video. Valuations, you can come up with a lot of different ways to do this. What we like to watch is something called the PE ratio. P standing for price and E is earnings. So what a PE ratio means is how much you're willing to pay, an investor is willing to pay for $1 of corporate earnings. And if you look going all the way back to 1871, when we have data for this, the median value is about 17. And it just gives you a sense of where we are in a business cycle. So if people are willing to pay higher prices, that's probably because the market's already gone up quite a bit. And that's sort of the case right now is we're at a value of 30. So if 17 is the median, 30 is pretty high. That's where we're at now. It's been as high as 44. And that was in December of 99 when the tech bubble happened. The lowest it's been is 5. And that's happened a couple times. And the most recent one was actually in the early 80s. So if you had to pick a time to invest, you would actually start when valuations are super low, right? That just probably kind of makes sense. Right now they're on the higher end. What I wanted to point out is that you can use that number to kind of forecast returns out over the next 10 years. This isn't my equation. This is from Jack Bogle, which is the founder of Vanguard, so one of the biggest investment companies in the world. And his equation for forecasting returns is you take the starting dividend yield on stocks, and then you add what your earnings growth is expected to be, and then you either add or subtract the change in PE ratio. So I know this is probably boring, but if you take right now, the beginning dividend yield right now is about 2%. We'll use Bogle's number for earnings growth of 4.7. So that's fine. That gets you to 6.7%. That's great. But the problem is the PEs are high. So if they go from high where they are now, from 30 basically back down to their average which would be 17, that's a headwind of 4.5% per year. But we're in this low inflation environment. So let's just say they go back to 21. That would be kind of what we would expect to see. That would be a headwind of about 2.5% per year. So if you run that all through the equation, that tells us that over the next 10 years, we would expect the stock market to average about 4.5% for the year, which is certainly well below, the 10% average. And the reason I bring that up, this isn't an exact science. It's not like this is what is going to happen, but the main thing I wanted to bring it up is just a way to help you and help us manage our expectations around what returns are going to be in the U.S. stock market, which is what this is following. But the other thing I wanted to point out is that we have plenty of other investment options. So you have corporate bonds that pay 4 or 5% as a fixed rate, and we also can find preferred stock that's paying 7% or more as a fixed rate. So take a breath and relax. I just wanted to at least give you some pointers on kind of where we are in the business cycle. And that's probably not news to you, but at least gives you an idea of more of a scientific way to forecast what we think returns might be in the market. The other thing that I wanted to go through is investor sentiment. And this is the good news part of this video. So in sentiment would be what the overall attitude or feelings are in the market. So how do you measure that? Well, there's the AAII, which is the American Association of Individual Investors. They have been doing a weekly survey going all the way back to 1987. And they just simply ask people, how do you feel about the markets? And the answer is either bullish, bearish, or neutral. And then they report the numbers every week. What's funny is that the study has had a completely opposite unintended result. The idea would be if a lot of people are reporting that they're bullish, that means that they're willing to pay for stocks and own them. Well, what they found out is that at the most bullish readings, the stock market tends to go down after that. And in the most bearish readings, the stock market actually tends to go back up. So because I'm a nerd and I wanted to quantify this, I took all the 1,650 different weeks that we have for data, and I ranked them from the most bullish all the way down to the most bearish readings. And then I calculated what the stock market's return was 52 weeks later. And in the middle, what you find is a bunch of noise. It's kind of all over the place. When it has the most bullish readings, when people are the most optimistic, the average return 52 weeks later is 0%. And on the bottom tenth of those most bearish readings, 52 weeks later, the average return is actually a positive 15%. So it's maybe not what you would expect, but the point is that at the beginning of the year, we had one of those top 10 most bullish readings, which again, remember, that would actually be a negative sign. And in fact, it seems like history is about to repeat itself. We're on track for basically a 0% year. The good news is that reading has come right back down to the middle. So, the good news is that it's not, at least that people aren't expecting really high returns. It's a little bit below average, which is, probably a good thing. And I'll post a link for this if you want to look at the report yourself. You can do that. The other thing is, so that's asking individual investors. There's another one which is called the Investors Intelligence Advisors Sentiment Report, and they do the exact same type of thing. It's averaged a little bit differently, but the point is, they thought, well, individual investors are getting it wrong. Let's ask the smart guys in the room what they think. And the funny thing is it turned out exactly the same way. So they've been doing this since 1963, and the numbers are almost identical. If you take the top 10 most bullish readings, 1 year later, 0% return. Take the top 10 most bearish readings, and 1 year later is a positive 17%. Again, at the beginning of 2018, was one of those top 10 most bullish readings, and we're on track for 0. And again, the point is we're right back in the middle right now. So, the good news is that it's at least not overly bullish, which is actually seems kind of ironic, but it's actually a good sign. So to kind of sum all of this up again, rates, it looks like the Fed is going to start pulling back rates, throttling back a little bit on that, which is a good sign. Reminder, valuations in U.S. stocks, they are high. That doesn't mean that the market's going to go down tomorrow. It's just kind of an indication of where we are in a business cycle. I just would point out again, I just wouldn't expect to see double-digit returns for the next 10 years. So just, maybe keep that in the back of your mind and plan accordingly. And also keep in mind that we have income investments that we can still get the rate of return that you probably need for your retirement. And again, from a sentiment standpoint, it's not overly bullish, which again seems ironic, but that's actually a good thing. So we think the market can go up another leg when you put this all together. If there is an ace up the sleeve in this whole current market cycle, we think it's something related to trade. So the administration's comments, even in the last week, have been pretty tough on China still. I don't think anybody's expecting anything positive to happen out of this G20 summit that's going to kick off, I think tomorrow actually, which is exactly why and it is a big if, but if something positive were to come out of that meeting on trade regarding China, we think it could be a huge boost for not only the end of the year, but going into 2019. So, it seems like all the bad news about tariffs and China trade has sort of already been baked into the market. I don't think any more news could be bad. So at least it seems like if any positive news would come out about that, it would definitely be a good thing. So that's all I got for now. We'll check back in December at the end of the year. Again, hope you guys have happy holidays. And if you have any questions or comments, feel free to shoot me a call or an email, and I'll look forward to talking to you again soon. Thank you.